I welcome you all to this session, and in this session we will be covering RBI Monetary Policy Committee and the various quantitative and qualitative tools used by RBI, which means various rates and ratios to control the money supply in the market, thus inflation, and what is meant by inflation, and the effect of these quantitative tools on controlling inflation, and what are the current ratios. First of all, let us understand what is Monetary Policy Committee. It's a 6-member committee. Out of these 6 members, 3 are from RBI and 3 are government nominees. And this must meet at least 4 times in a year, which means at least 3 times in every year to decide various quantitative tools such as repo rate, reverse repo rate, MSF, statutory liquidity ratio, CRR, bank rate, etc. So by controlling these measures, RBI effectively controls the total money supply in the market, which tends to price stabilization, and it improves the growth of the economy. To control the total money supply in the market, RBI uses 2 kinds of tools, namely quantitative tools and qualitative tools. Quantity itself means the volume of money. Okay, it's a physical measure. It includes repo rate, reverse repo rate, CRR, statutory liquidity ratio, marginal standing facility, bank rate, and open market operations. We will study in detail about quantitative tools in this video. And in qualitative tools, RBI uses margin requirement, selective credit control, and moral suasion. Marginal requirement means, for example, if you are going to borrow some money from the bank by using a collateral of a property or such that RBI instructs the bank that certain percentage of money is to be kept aside, which means only 70 or 80% of the market value of the property to be lended. Okay, such that so the borrower can only get the cash up to certain percentage of the original value. And next is selective credit control. It's like priority sector lending, such that RBI controls the credit sectors to which the banks are lending, like MSMEs and other agriculture and entrepreneurship areas. Thus RBI makes sure that the money is not going into speculation and stock market, such things. Okay, the next one is moral suasion, which means RBI persuades the banks that the money is to be kept in the form of government securities, goals, etc. Next, we will understand what is meant by inflation. Inflation is generally the sustained increase in commodity prices over time, which means the price of our commodity daily consumables are increasing than last time. Okay, it increases the cost of living. It generally means too much money in the hands of people and too much money is chasing too few goods. Okay, do you understand that? Which effectively reduces the purchasing power of our money. For example, last year 1 kilogram rice is sold at 30 rupees, but in this year the 1 kilogram same is sold at 40 rupees. So more money is needed now to buy the same quantity of good. This is inflation. Okay, the reasons of inflation are generally 2 types: cost push and demand pull. What is meant by cost push inflation is the raw materials used for the making of consumables and products are increasing. So when the raw material cost increases, the overall price of the commodity also increases. This is one method. And the demand pull, this is generally we see in the case of gold and diamonds, too much demand but the quantity is limited, so the price level increases in the market. Now let us look into various quantitative tools used by RBI to control inflation. First, let us look at what repo rate is. It is a repurchase agreement between RBI and commercial banks. Repo rate is the interest rate charged by RBI when banks borrow from RBI to eliminate their mismatches. Okay, so when repo rate increases, so the interest rate is increasing. Okay, so the banks must pay more money to RBI. So it is costly to buy from RBI. Thus they won't prefer it unnecessarily. Thus the effective money in the hands of banks are decreasing, which means they don't have much money to lend to the market, to the businessmen, to the common people. Okay, so the overall cash flow in the economy is decreasing when repo rate increases. What happens when the overall cash flow in the economy decreases? Inflation also decreases. Understand? Okay, let us look up otherwise. What happens otherwise? When the repo rate decreases, then banks can afford to borrow from Reserve Bank. So they will borrow more. So they will have more money to lend, which means more money in the hands of businessmen. They will take loans from banks. So there is too much money in the market, which starts to chase too few goods, which means the inflation heightens. So do you understand the relation between repo rate and inflation? It is inverse relation. Okay. Now let us look what is meant by reverse repo rate. It is just the opposite of repo rate. It is the interest rate RBI gives to the banks for their deposit with RBI. It is like the banks giving us interest for our deposits with bank FD, like that. Okay. So what happens if reverse repo rate increases, which means RBI is willing to give more money to the commercial banks to park their money with RBI. So they will prefer to park more with RBI to earn more. Okay, why to take the market risk? This is a short profit. Like, so they will prefer to park more money with RBI. Consequently, they will have less money to lend. Okay, so our businessmen won't get enough money from the banks. So the overall cash flow in the economy decreases and inflation also decreases. Here also an inverse relation can be observed. When reverse repo increases, inflation decreases. Understand? Just the opposite is when the reverse repo rate decreases. You can understand that. Just think. Okay. Now let us look what is meant by CRR. It is cash reserve ratio. It is the ratio of banks' net demand and time liabilities banks need to keep with RBI, like a deposit. Okay. So it is a percentage of NDTL of banks to be kept with RBI. Okay. When CRR increases, which means more percentage of banks' net income to be kept with RBI. So less money for the banks to lend. So the overall money supply in the market decreases, thus decreased inflation. Here also an inverse relation can be observed. When CRR decreases, what happens? There is less money to be kept by commercial banks. So they will have more money with them to lend. Okay, so more money supply in the market, consequently inflation rises. The next one is SLR, which means statutory liquidity ratio. These are the percentage of NDTL, net demand and time liabilities of banks that to be kept with themselves. Okay, CRR, which means the cash to be kept with RBI. Here, the money to be kept with themselves. That is to meet the withdrawals and some urgent works, the urgent need of cash. Okay, so they need highly liquid assets like gold and government securities. Okay, what happens when SLR increases? Same in case of CRR. More money to be kept with themselves, so less money to lend, so less cash flow in the economy, and inflation decreases. Inverse relation, same as CRR. Okay. The next one is MSF, which is marginal standing facility. It is the interest rates banks borrow, same as repo rate. The banks borrows from RBI. RBI charges MSF rate. This is an urgent fund. Okay, it's an overnight fund. When banks need urgent money overnight, they can use this facility. So the MSF will be always greater than repo. Okay, so RBI earns more from this. RBI is not a profit-oriented organization. I'm just saying that. Okay, next one is bank rate. This is also a liquidity adjustment facility like MSF given by RBI to the banks. Here, just the difference between is MSF is an overnight fund and the bank rate is for long term. Currently, MSF and bank rates are same 5.15% at this time. Okay, 30th of July 2022. Okay, so these two are same, just difference in case of the time period. And the next tool is open market operations. This is the buying and selling of government securities by RBI to control the money supply in the market. When RBI is willing to buy government securities from commercial banks and from the market. So what happens? The commercial banks are selling government securities to RBI and RBI is giving money to them. Okay. So when RBI buy G-Secs, more money is given to the commercial banks, thus they have more money to lend, so the cash flow increases in the economy, thus inflation also increases. Inflation is necessary for the growth, right? Inflation also is a parameter to measure the growth of an economy. Certain 2 to 3% of inflation is necessary for the growth. Okay. So what happens when RBI is selling the government securities? So when RBI sells the government securities, RBI giving G-Sec to the commercial banks and commercial banks are paying to RBI. So their money is going to RBI. So the net money to lend decreases with the commercial banks. So less money to the businessman, less money in the market, thus inflation decreases. I hope you are all clear with these quantitative tools of RBI. Okay, and OM open market operations are to deal with the temporary liquidity mismatches. When foreign money and FDI inflows into the market, so a mismatch arises in the market. To deal with that, open market operations are performed by RBI. And now let us look at what are the current rates. You should note that this is the current rate as of 30th July 2022. These are the rates decided by the Monetary Policy Committee of RBI. The current repo is 4.9%, reverse repo is 3.35%, CRR is 4.5%, SLR is 18%, MSF is 5.15%, bank rate is 5.15%. You need to mug up this, you need to remember this. Okay, direct questions can be asked in any examinations. Okay, so here it is given percent. What is this percent? Percentage of what? It is the percentage of net demand and time liability, NDTL, of the bank. Now, what is meant by NDTL? It is the difference between net liabilities and the deposits, which means the assets of bank. Okay, the demand deposits and time deposits made by the account holders, which means us, and the business with the banks are their liabilities. Okay, which means they have to return us with interest. It is subtracted by the assets of the bank, which means the bank will have many deposits with RBI and other banks, right? Okay, so they are also earning interest. It is the net difference between liabilities and assets of the bank. So all these percentages mentioned here are of the net demand and time liabilities. Okay, that's all about this presentation. I hope you all understood what meant by me. Thank you.